Sure. And by the way, you're right about this week, Julia. By the happy birthday, by the way. Yeah, Tuesday we have some, without getting too down the weeds, Tuesday we have some important elections in Wisconsin and Florida. Mm-hmm. Wednesday is Tariff Day, Phase 1. Thursday is Tariff Day, Phase 2. And then Friday is the March employment report. So there are sort of big landmines out there every day this week, and the markets are nervous enough as it is. So you're absolutely right about the situation. So big picture, what's going on? I don't think I invented this phrase, but I'm calling it MAGAnomics, and I think others have come up with the same phrase. But kind of what's under that umbrella, if you will? And it's not, none of it is overly complicated, but it has a lot of moving parts, and you really have to sort of go kind of step by step to see how it's all playing out. Just digress quickly with regard to the tariffs. One of the reasons the markets are so nervous, I always say that markets can deal with good news and they can deal with bad news. They can't deal with uncertainty when they don't know what the news is. People just kind of sell and go to cash and look for liquidity and safe harbors and all that. And the problem with Trump, it's an advantage and a disadvantage at the same time. He likes to, he's the art of the deal. He's highly transactional. He likes to keep people off balance. There's something to be said for all that. I think Napoleon and Richard Nixon did the same thing. But as I said, it's very, very confusing for markets. So is he actually going to do all the tariffs on Wednesday and Thursday that he said? He might. I'm not saying he's bluffing at all, but I am saying that there are back channel discussions going on, and we could wake up a Wednesday morning and he said, well, I'm putting these tariffs on China and Canada just the way I said, but we got to deal with Mexico. I'm not forecasting that. I'm just saying that that's the kind of uncertainty that we're dealing with. The auto parts thing, auto manufacturing, assembled autos, seems real. I think they're going to go through with that. And, obviously designed to promote the auto industry in the U.S. I mean, Trump's basic message when it comes to tariffs is, to foreign companies, whether it's China, BYD, the big auto companies based in Canada, Mexico, Europe, with everything. Volkswagen has not done a good job of getting their plants in the United States. They're a little bit behind the curve there. But whoever it is, he's saying, look, you can sell all the products to Americans that you want, but you have to build it here. Put your plants in South Carolina or Tennessee or Mississippi, Michigan, as the case may be. But the point of tariffs, it will collect money. Tens or hundreds of billions of dollars. But the real point is jump the tariff wall by putting your plants in the United States. And there have been a lot of announcements along those lines, as I'm sure you and your audience know. Honda, Hyundai, Taiwan Semiconductor, Apple, which is a U.S. company, but puts most of its investments abroad. They're all putting stakes in the ground in $50 or $100 billion plants in the U.S. So that's all going on. But the real problem is, will Wednesday and Thursday play out the way we expect? We'll find out Wednesday and Thursday, but that's the problem. There's one thing to say, here's what we're definitely doing, and here's the date. But Trump says, here's what we're going to do, here's the date, but I might change my mind. That's very, very hard for markets to digest. But the best assumption is, the tariffs are going on. That explains why the stock market's going on. I talked to someone I know very well, who's an Audi dealer in the United States, kind of like in a high-end zip code. He has been in the business over 30 years. And he said they have never been busier. People are actually selling cars like crazy. People are lined up in the showroom. But that's because of the tariffs. In other words, Audi is a foreign manufacturer. They're going to get hit possibly with 25% tariffs beginning on Wednesday. So if you like an Audi, buy it now out of inventory off the lot before the price goes up 25%. So that's good for his business in the meantime. But the problem is, everything's going to fall off a cliff on Friday. We got, basically, you're taking 6 months of demand, moving it forward to beat the tariffs. And that's good in the short run if you're in any of those sales areas. But you're just going to hit a wall on Thursday, and it's going to take. You can't build an auto plant overnight. It takes two years, possibly longer, and so it's going to take a while to adjust to that. So a lot of disruption going on. But getting back to the big picture, what I call MAGAnomics, there are three principles, three individuals, and think of it as a three-legged stool. So I'll just go through the three legs of the stool very, very quickly. The first one is called the Three Arrows Plan, also known as the 3-3-3 Plan. And this was proposed by Scott Bessent, Treasury Secretary. And, we can do calculus if you want, but it's really fifth grade math. He basically says he wants deficits below 3% of GDP. And that's where Doge comes in and, cutting all the expenditures. But there's a lot more to it than that. I mean, Doge is doing a lot of good work, but, if it's wasteful, cut it out by all means. But those numbers, even 100 million here, a billion there, it takes a long time for that to add up to $1 trillion. So they're going to need to do more radical surgery than that. But basically, get deficits below 3% of GDP. The second leg of the stool, the second three, if you will, is get real growth at 3% or higher. But the key thing there is real growth. We'll come back to that in terms of inflation. And then the third leg of the stool is 3 million new barrels of oil per day. Added production, 3 million barrels of oil a day. So 3-3-3, deficits below 3% of GDP, 3% real growth, and 3 million barrels of oil. What does that do? People say, well, we got 34, actually more at this point, probably $35 trillion of national debt, which is true. We can't pay off the national debt. What are we going to do? So you don't have to pay off the national debt. We haven't done that since 1836 under Andrew Jackson. You don't have to pay off the national debt. You do have to roll it over. When outstanding Treasury securities, bills, notes, and bonds come due, you've got to basically issue new ones to pay off the old ones and keep it going. We've been doing that for 230 years. So what's the key to that? The key is sustainability and confidence. If you lose, it becomes not sustainable when the world market loses confidence in your ability to somehow keep it under control. What's the best measure of that? What's the best way to think about whether national debt really is out of control? The answer is it's a very simple ratio, debt to GDP. What's the national debt and what's the GDP? Now, you have to think of both of those in nominal space. I always bang the table about real versus nominal, but here, when it comes to debt, it's nominal. If I owe you $1, I owe you $1. Whether it's worth $1.10 or 98 cents based on inflation, interesting, but I owe you $1. Right now, that ratio is over 125%. I mean, it changes every day. We're paying so much interest. But it's over 125%, the highest in U.S. history. The last time it was close to that high was immediately after World War II. 1945 was about 120%, but I say at least we won the war. We were a global hegemonic economic power. We got something to it. And by the way, from 1945 to 1980, that dropped from 120% to 30%. 30% totally sustainable, totally comfortable. It's like a small balance on your credit card. You have no problem paying it up. Since 1980, it's gone from 30% to 125%. So who's at that lunch table? Well, it's Lebanon, Greece, people you don't really want to be with. So the national debt is not going to go down. It's going to keep going up. But the key is the ratio going down. And that's where the three arrows come in. If the deficit's going up less than 3% of GDP,